Hi and welcome to SQE Success, your pathway to becoming an English solicitor. In this video, we'll explore 3 scenarios involving taxation from property transaction, a key topic in business taxation under FLK1 and property practice under FLK2. Let's dive in. A parent company is engaged in property development. It sells all the issued shares of its wholly owned subsidiary to a third-party buyer. The subsidiary's only asset is a residential investment property originally purchased for £100,000. The buyer pays £250,000 to acquire the shares of the subsidiary company. What is the correct tax treatment of this transaction? A. The parent company is liable for capital gains tax and the subsidiary is liable for SDLT. B. The subsidiary company is liable for chargeable gains tax and the buyer is liable for SDLT. C. The parent company is liable for corporation tax and the buyer is liable for stamp duty. D. The parent company is liable for capital gains tax and the buyer is liable for stamp duty. E. The parent company incurs no tax liability, but the buyer is liable for SDLT. The best answer is C. The parent company is liable for corporation tax and the buyer is liable for stamp duty. When a company sells shares in a subsidiary, A. The parent company is disposing of a chargeable asset, the shares, and any gain is subject to corporation tax, not capital gains tax, because companies pay corporation tax on chargeable gains. B. The buyer is acquiring shares, not property. Therefore, the correct tax is stamp duty, not SDLT, which applies to the transfer of shares. Scenario 2. A partnership consisting of 3 partners is engaged in property development. The partnership sells a commercial investment property that it originally purchased for £100,000. The buyer pays £250,000 to acquire the property. What is the correct tax treatment of this transaction? A. The partnership pays corporation tax on the gain and the buyer pays stamp duty. B. The individual partners are each liable for capital gains tax on their share of the gain, and the buyer pays SDLT. C. The partnership pays capital gains tax on the gain, and the buyer pays SDLT. D. The partnership pays corporation tax on the gain and the buyer pays SDLT. E. The individual partners are each liable for income tax, and the buyer pays SDLT. The best answer is B. The individual partners are each liable for capital gains tax on their share of the gain, and the buyer pays SDLT. A partnership is not a separate legal entity for tax purposes. When it disposes of a chargeable asset, like commercial property, the gain is attributed to the individual partners. Each partner is taxed under the capital gains tax regime on their share of the gain. The buyer is acquiring a commercial property, so they will be liable for stamp duty land tax, SDLT, on the purchase price. Scenario 3. A couple sells their matrimonial home to another couple for £250,000. The selling couple originally bought the property 10 years ago for £100,000. The purchasing couple are first-time buyers acquiring their first residential property. What is the correct tax treatment of this transaction? A. The sellers are liable for capital gains tax on the profit, and the buyers pay SDLT at the standard rate. B. The sellers are liable for capital gains tax on the profit, and the buyers pay SDLT with a first-time buyer discount. C. The sellers pay income tax on the gain, and the buyers pay SDLT. D. The sellers are exempt from SDLT, and the buyers do not need to pay SDLT as first-time buyers. E. The sellers benefit from full private residence relief, so no capital gains tax is payable. The buyers pay SDLT with a first-time buyer discount. The best answer is E. The sellers benefit from full private residence relief, so no capital gains tax is payable. The buyers pay SDLT with a first-time buyer discount. In respect of the sellers, because the property has been the couple's main residence throughout ownership, they are entitled to full private residence relief, PRR. Therefore, no capital gains tax is due on the sale. In respect of the buyers, as first-time buyers purchasing a residential property for £250,000, they qualify for the first-time buyer SDLT relief. This table illustrates the legal principles concerning the taxation arising from property transactions. In Scenario 1, when a parent company sells shares in its subsidiary, any gain from that disposal is subject to corporation tax, as companies pay corporation tax on chargeable gains rather than CGT. Since the transaction involves shares, stamp duty applies, not SDLT, which only applies to land transactions. In Scenario 2, a partnership selling commercial property is treated as tax transparent, meaning the property disposal is attributed to the individual partners. Each partner is therefore personally liable for capital gains tax on their share of the gain. As the buyer is acquiring land directly, SDLT applies. In Scenario 3, a couple sells their main residence to a pair of first-time buyers. The sellers benefit from private residence relief, which exempts them from CGT because the property was their primary home. The buyers qualify for first-time buyer SDLT relief, which reduces the SDLT payable on the purchase. Have you noticed how a slight change of fact can affect the legal outcome? That's exactly the skill the SQE tests, and mastering it is key to exam success. I published books filled with MCQs, each built with 3 variations of a legal scenario to sharpen your analysis and deepen your understanding. It is a must-read to pass SQE1. Turn your ambition into qualification. Begin your SQE journey to become an English solicitor.